Feeling bogged down by accounting? Fear not, this is Accounting for Business Decisions A, and we're going to discuss trial balances. In a feeble attempt to make accounting interesting, let's think of trial balances as a multi-layered cake. Trial balances are a listing of account balances, and much like a cake, they are made at a specific point in time. Now, suppose we cut up the cake for the purpose of this explanation. The left portion corresponds to the left column of the trial balance, and is categorized as the account name column. The various layers of the cake can then be used to represent the general accounts taken from the ledger, which are usually posted in the format as follows. The icing layer, assets, crust in unpleasant liabilities, spongy equity and then revenue, following expenses, and then lucky last layer, dividends. These layers or accounts are then listed in the appropriate debit and credit columns. The cherry on top of the cake representing the entity's name and accounting period end. As the cake satisfies sugar cravings, trial balances aim to satisfy both credit and debit columns. Therefore, to prove that no mistakes have been made during the accounting cycle, credit and debit sums must be equal. Perhaps one of the most useful functions of a trial balance is its ability to store all the entities' accounts and their balances in one place, thus making it helpful and easier in making adjustments to account balances at the end of an accounting period, which goes on to prepare financial statements. If we were to say that a recipe was metaphoric of a journal, then the flour, eggs, and butter would be the ledger. Following this process, it would make sense that the cake would end as a trial balance. Thus, trial balances complete the recording process of the accounting cycle for a specific period. Anyway, this was Accounting for Business Decisions A. Thanks for listening, and I can guarantee you'll never look at cake the same way again.